Hi, Stan The Annuity Man. Today's topic is what is an income rider on an annuity? A lot of annuities being sold today have these attached income riders that sometimes sound too good to be true. Always remember that if it sounds too good to be true, it is every single time without exception. So what we're going to do today is explain how these income riders work so you can make an informed decision on your time frame and on your terms. Also, remember to watch my video, What is the Purpose of an Annuity? Which is a good one as well. Boy, do we have a lot to cover with income riders, so you'll be informed about what they do. So we're going to talk about, what is an income rider? How does it work? What does it solve for? We're going to go over benefits and limitations so you understand those fully, because all annuity types have benefits and limitations. We'll talk about how to get a quote, what to look for in the quote, how to structure the quote, talk about how it fits in the overall portfolio with what you have and what you're trying to achieve. And at the end of the video, if you hang in there with me, I'll show you how to get my Income Rider Owner's Manual for free. So what is an income rider and what does it solve for? An income rider is a guaranteed income payment at a future date that you choose. It's really that simple. That's what it solves for. How does it work? It's a separate calculation from the annuity that you've attached it to. So let's say you attached it to a variable annuity or an indexed annuity, fixed indexed annuity. Let's just visually draw a line down a blank sheet of paper. Okay. This side is the accumulation value side, which for variable annuities are the separate account mutual funds. And for index annuities, it's the index option strategies that's going to create CD type returns. And on this side is that income rider guarantee. So two separate calculations, both growing differently. Typically, the income rider calculation is growing at a specific percentage that is going to grow during the deferral years. Once you turn on the income stream, that percentage of growth stops. But you have to understand that percentage is monopoly money. You can only use it to calculate that first payment. It's not interest. You can't peel it off or cash it in or trade it to another annuity. So that's kind of how it works. Also, it's important to point out that with all lifetime income, it all comes down to life expectancy. So with an income rider, when you start the payment, is primarily going to be the driving train of the pricing. So the older you are, the higher the payment. The younger you are, the older the payment. Similar to Social Security. So everything's life expectancy based, and life expectancy is the primary pricing mechanism, with interest rates playing a secondary role. So let's talk about the benefits of income riders. There's a lot. I mean, these are nice attachments if you're using them for the right thing, and primarily the goal is future income. You can set it up joint with a spouse or partner, which is good. You can use it inside of an IRA or non-IRA. You can attach it to a variable annuity or index annuity, and I would encourage you to quote all carriers for the highest contractual guarantee. It is flexible, so let's just say you went into the contract, you said, I want to start income in 12 years from now or 7 years from now, and things changed in between and you need to start it sooner or later. You can do that with an income rider. You're not locked into that initial start date that you put on the application. Obviously, with income riders, the benefit is you're never going to outlive the income, but there are some that provide a death benefit as well, which is good for people that can't qualify for life insurance. And also, some income riders provide what's called confinement care benefit, meaning that when you can't do 2 of the 6 daily functions of life, which is feed yourself, clothe yourself, bathe yourself, number one, life isn't good. Number 2, you're going to live 3 to 7 years is what they say, what the studies say. But what happens is when you have a confinement care rider is they just increase the payments to you. When you're sicker, you get your money back quicker. But you know what? That's a pretty good thing when you're at that time of your life and you need a little bit more extra income maybe to cover medical expenses, etc. So those are kind of the benefits of income riders. Okay, let's talk about the limitations of income riders. And a lot of the limitations come about from some bad sales pitches and some misconceptions that people have hearing a sales pitch, whatever. But with that being said, we have to cover them. You have to understand what they are and make a good decision. Number one, a lot of these income riders have a high percentage yield. And you go, wait a minute, that sounds great. I'm getting a 6% or 7% growth on that income rider amount. That's not yield. Jimmy Carter's not in office. There's not some genius at an annuity company that's figured out how to give you high yield, okay? What that is monopoly money that grows until you decide to take income, and when you take income, that percentage stops, but that income stream is based on that amount. You can't peel off the interest, you can't transfer it, you can't get it in a lump sum. But that's okay if you know the rules. But don't call me up and say, hey, Stan, I got a 7% annuity or an 8% annuity. I get that all the time. No, you don't. You have an income rider, which is monopoly money that can be used to calculate that first income payment. And that's okay. The other thing too, on those income riders, amounts that are growing by those percentages, that annual fee from the rider is taken out of that other side. Remember I drew the line down the middle sheet of the paper, accumulation value, income rider value. The rider fee comes out of the accumulation value for the life of the policy. And it grows by that percentage during the deferral years. You need to know that, right? So let's just say the percentage is 7.2% it's growing by on this side. And you held it for 10 years. And when you started, the percentage was 1% fee, annual fee, and it's growing by 7.2%. At the end of 10 years, when you turn on the income stream, it's doubled, right? The fee is now 2%, and you've locked in that 2% annual fee for the life of the policy. Is that a good thing or a bad thing? It's a bad thing if you don't know it, but if you know it, then you'll factor that into your decision. Because if you're buying the income rider for what you should be buying it for, which is the guaranteed income stream at the future, then all of that's irrelevant. But you need to know all of those limitations. Also, too, from a taxation standpoint, and always go to a CPA or tax lawyer for real tax advice, but most income riders out there are LIFO, last in, first out, gains first at ordinary income levels. So let's talk about structuring choices and how to get a quote and all of that stuff. That's important. With income riders, you can have it just on your life, or you can have a joint life with a spouse or partner, etc. And the majority of income riders, when you pass away, if both of you pass away at the same time and it's joint, 100% of the unused money and the accumulation value goes to the beneficiaries. If the income rider is a death benefit as well, they get that amount. But typically the annuity companies do not keep a penny, even though they're on the hook to pay you for the rest of your life. From the standpoint of quoting, I mean, you quote income riders like you quote all annuities. All annuities are commodities. There's not one company that has the best, even though agents and advisors might tell you they found the best one for you. Translation, they might have found the best one for them, right? Or they haven't done their homework, give them a little bit of leeway. You should quote it just with all carriers, as many carriers as humanly possible for the highest contractual guarantee, knowing that those quotes change all the time, every 7 to 10 days in a lot of cases, but you need to quote them all. It's like buying a plane ticket, so that's how you go about finding the best income rider, because at the end of the day, it's about the highest contractual guarantee for your specific and customized situation. So where does it fit in your portfolio? We've gone over a lot of the good and the bad. At the end of the day, income riders are for income later. It's an income product. It's a future pension guarantee that you can set up for yourself using IRA or non-IRA money. So that's the primary reason you use it. Secondary reasons would be legacy. If there's a death benefit attached, you could use it for that. Or if you wanted to do joint life income with a spouse or partner, that legacy would be the continuation of the income stream uninterrupted and unchanged. And also you could use it for confinement care if you can't qualify for traditional long-term care, or you need secondary coverage, a little bit more coverage to make you feel better and more secure. You can use it for that as well, which in essence is getting your money back quicker when you get sicker. It's not a bad thing, but it's just reality. With that, that's where income riders fit. Now, remember the first part of the video I said you can get my book for free? You can. This is it, Income Rider Owner's Manual. I'll send you that for free. No obligation, no cost. No one shows up at your door or calls you on the phone, I promise. And you get it in this package, this nice gold foil package. So that's what I'm going to do for you. What I'd like for you to do for me is click the button below, Stan The Annuity Man YouTube channel, and subscribe. Why? Because I'm putting these videos out all the time, and they're informative, they're timely. You can get educated on your own terms. You can make informed decisions without sales pitches, which is what you need to do. People always say to me, hey, Stan The Annuity Man, aren't annuities sold? They're not bought? Not in my world. In Stan The Annuity Man world, they're bought, not sold.